OpenAI just hired some of the biggest names from Wall Street and Silicon Valley, and it's not for product development. It's to prepare for something that could be the biggest technology IPO in history. Think about what that means. OpenAI went from a non-profit research lab to a for-profit company worth north of $80 billion. That's more than Tesla was worth when it went public. But here's the thing, publicly traded means scrutiny. Regulators, investors, analysts, they'll all want to understand how this company makes money, why it burns cash, and where it's headed. Enter the big guns. Over the past few weeks, OpenAI has quietly brought on seasoned executives from Apple, Google, Microsoft, and major investment firms. People who have taken companies public before. People who know how to handle billion-dollar business operations. People who can translate cutting-edge AI research into financial reports that Wall Street understands. Why does this matter? Because hiring these specific people signals something concrete. The IPO is coming sooner than we thought. You don't bring on that level of executive talent months before a major public offering. You bring them on weeks or days before the filing. The question isn't whether OpenAI will go public anymore. And here's where it gets interesting. What happens to the AI landscape once it does? Before we dig into who OpenAI hired, let's talk about why this matters at all. An IPO, initial public offering, is when a private company sells shares to the public and gets listed on a stock exchange. Think of it like opening a restaurant. At first you own it outright, then you decide to let investors buy a slice of the business in exchange for capital. OpenAI needs that capital. Current estimates suggest the company burns somewhere between $1 to $2 billion per month just on compute costs, renting GPUs from cloud providers, paying salaries, running data centers. That's roughly $15 to $24 billion per year just to keep the lights on. Even with revenue from their API and ChatGPT Plus subscriptions, that burn rate is astronomical. An IPO solves that problem dramatically. Instead of relying on venture capital rounds, where they give up equity to investors, OpenAI can raise potentially tens of billions of dollars by going public. It also gives them currency. They can issue stock to acquire smaller AI companies, offer competitive employee compensation packages, and invest in research. But going public means accountability. They'll have quarterly earnings calls, regulatory filings, shareholder demands for profitability. That's why they are bringing on experienced executives right now. So who exactly did OpenAI bring on? The reported hires include executives who have navigated massive corporate transitions before. One hire came from Apple's operations division, someone who managed supply chains worth hundreds of billions of dollars. Another came from Google's finance team, where they helped oversee one of the most complex corporate structures in tech. A third came from Goldman Sachs, where they spent years preparing companies for public markets. These aren't researchers. These aren't product managers. These are the people who make billion-dollar organizations actually run. They understand accounting standards, securities law, shareholder communication, risk management, and the 1,000 tiny decisions that separate a smooth IPO from a disaster. What's interesting is the pattern. OpenAI isn't hiring flashy product visionaries. They've got Sam Altman and the AI team for that. They're hiring operational excellence experts, people who can scale without breaking, people who can explain AI research to financial analysts, people who can help OpenAI navigate regulators who don't yet fully understand what they are building. One more critical thing, hiring this talent level costs serious money and equity. The fact that OpenAI is willing to pay top-tier executive salaries plus massive stock grants tells you something about their timeline. You don't spend that kind of treasure on long-term planning. But here's what the headlines aren't telling you, the real reason the timing matters. Let's get concrete. What do these executives actually do on day one? The operations hire comes in and builds the financial infrastructure, budgets, forecasting, cost controls. They help OpenAI answer the question every investor will ask. How much does it actually cost you to serve one user? Right now, running ChatGPT isn't cheap. Each response requires GPU time. That person figures out how to optimize that cost while maintaining quality. The Google finance executive helps with something equally critical, corporate structure. OpenAI is currently a complex hybrid, partly non-profit, partly capped profit, partly for-profit entities stacked together. That won't work as a public company. They need clean, simple financial statements. This person unravels that and creates structure that regulators will approve. The Goldman Sachs person does investor preparation. They've literally done this dozens of times. They know which questions regulators will ask, which financial metrics matter, how to position OpenAI's story. They've worked with companies that had sketchy margins, regulatory risk, or uncertain futures. Sound familiar? They know how to make those stories compelling to institutional investors. The Apple operations person also brings something else: supply chain thinking. If OpenAI wants to build its own chips or hardware, they'll need someone who's done that at scale. Apple doesn't just design hardware, they orchestrate manufacturing across dozens of countries. That's the kind of expertise you want before you scale. And this is where things get complicated. How does this compare to other major AI company public offerings? Well, here's the thing. There haven't really been major AI company IPOs yet. That's what makes this historic. The closest parallel is Google's IPO in 2004. Google was also burning massive cash on infrastructure while generating uncertain revenue. They were growing fast, but the business model wasn't proven yet. They brought on experienced finance people and survived Wall Street scrutiny because their revenue eventually proved the model worked. OpenAI's situation is different in one critical way. Their burn is higher and their revenue model is newer. Google had search ads working. OpenAI is still figuring out whether API usage, ChatGPT plus subscriptions, and enterprise deals can cover the costs. That's riskier. Microsoft, by comparison, went public decades ago in a totally different era. NVIDIA's IPO was also in a different time. Neither faced the scale of compute costs or regulatory uncertainty that OpenAI faces today. What's telling is that OpenAI didn't hire a traditional investment bank to lead the IPO yet. They are building internal infrastructure first. That suggests they want control of the narrative and timing. They are not being forced public by investors. They are choosing when and how. That kind of confidence only comes from either incredible growth or preparation for a major announcement. But here's the twist nobody expected. The real risk isn't the IPO itself. Let's zoom out. What does OpenAI going public actually mean for the broader AI industry? First, it validates the market. When a company with astronomical burn rates can go public, it signals that investors believe AI infrastructure companies are actually viable long-term businesses. That's huge for Anthropic, DeepSeek, Mistral, and every other AI startup. They all become more fundable because OpenAI proved the model. Second, it accelerates consolidation. Once OpenAI has public currency, stock they can issue, they become an acquisition machine. They can buy AI startups, offer employee packages that smaller companies can't match, and integrate cutting-edge research faster. That's good for them, rough for competitors. Third, it brings regulatory intensity. The Securities and Exchange Commission will require OpenAI to disclose risks, capabilities, and safety measures in quarterly filings. That means every concerning AI development becomes a regulatory filing issue. It also means OpenAI's safety research becomes more transparent than ever. Fourth, and this is critical, it changes the power dynamic. Right now, OpenAI answers mostly to Sam Altman and their board. As a public company, they answer to shareholders. Quarterly earnings pressure is relentless. That could accelerate product launches, or it could force them to cut long-term research spending. Fifth, it means other countries will accelerate their own AI companies to compete. China, the European Union, the United Kingdom, they'll see a trillion-dollar AI company go public and realize they need their own. Here's what this means for you. Let's break down what actually happens in an IPO so you understand what's coming. Phase 1 is roadshow. OpenAI's executives will literally travel the world pitching the company to institutional investors. They'll show financial models, explain why they are different from other tech companies, answer tough questions. These aren't casual meetings, they are high-pressure negotiations about valuation. Phase 2 is pricing, based on investor demand. Underwriters set the initial share price. If investors think OpenAI is worth $300 billion and they're offering 200 million shares, each share starts at $150. That initial price is crucial. Too low and early employees feel robbed. Too high and the stock crashes on day one. Phase 3 is launch. Trading begins. The first day is always chaotic. Sometimes shares double, sometimes they collapse. The market is pricing in expectations about future growth. Then comes the hard part, maintaining profitability or at least showing a path to it. Every quarter, OpenAI reports earnings. If they are missing growth targets or burning more cash than expected, the stock price falls. That's the constant pressure of public markets. What should you watch for? First, their regulatory disclosures. OpenAI will have to acknowledge AI risks more explicitly than they do now. Second, their gross margins on IPI usage. That tells you whether their business model actually works. Third, customer concentration. If most revenue comes from Microsoft or one other customer, that's risky. These details matter because they'll determine if OpenAI becomes a long-term winner or a spectacular failure. And that leads to the real story. Here's what matters. OpenAI bringing on heavyweight executives signals we're entering a new phase of AI development. Not the phase where scrappy startups build cool models. The phase where trillion-dollar companies scale those models and figure out how to make money from them. This IPO won't be the biggest story in tech. The work they've done on large language models already is. But it will be the moment the AI industry grows up, when startups become corporations, when researchers answer to shareholders, when every AI breakthrough becomes a quarterly earnings event. For you personally, 3 things matter. 1. If you work in AI, this accelerates consolidation. Start planning your career accordingly. 2. If you're an investor, watch OpenAI's financial filings carefully when they come out. 3. If you're just interested in where AI is headed, understand that public companies are slower to take risks, but faster to scale. OpenAI's products will reach more people, but the research pace might actually slow down. The executives they've hired are preparing for the moment when OpenAI stops being the scrappy AI company that shocked the world and becomes the AI equivalent of Microsoft or Google, powerful, profitable, and careful. Follow for daily AI news. We'll break down what happens next and what it means for your world.